You've probably seen the headlines this week. U.S. debt auctions keep clearing just fine, demand looks solid, and the message from some corners of financial media is basically, nothing to see here, move along. On the other side, you've got channels warning that the bond market is broken, that foreign buyers are gone, and that this is the beginning of the end for the dollar system. A lot of noise, a lot of certainty, very little clarity. Today I want to slow this down and actually look at what's happening beneath the surface. Who is buying U.S. debt, who isn't, and why that distinction matters more than the headline bid-to-cover ratios. This is Financial Briefing, and if you're here, you know the goal isn't hype or doom. It's context, probabilities, and a framework you can actually use. Before we get into the data, I want to do a quick scorecard because accountability matters. Back in late 2023, when the 10-year yield pushed above 4.7%, I said the odds favored consolidation rather than an immediate breakout to 6%. My base case was a range between roughly 4 and 5% for several months. That played out. In early 2024, when silver spiked through $29, I said the upside momentum was real but vulnerable to a pullback if real yields didn't roll over. Silver pulled back into the mid-26s before rebuilding. And just this past spring, when a lot of commentary was calling for an imminent dollar collapse, I said the dollar index was more likely to stay range-bound than trend lower aggressively. That's also been the case so far. I get things wrong sometimes. I underestimated how persistent fiscal issuance would be. But the point is to stay grounded in data, not narratives. So let's talk about the core issue. U.S. debt keeps clearing, but the real buyers are missing. The first data point is the sheer scale of issuance. Over the last 12 months, the Treasury has issued roughly $3.2 trillion in net marketable debt. That's not gross issuance, that's net of maturities. Historically, even during the post-2008 period, net issuance closer to 1 to 1.5 trillion was considered heavy. We're running more than double that pace. What it means is the market has to absorb an unprecedented amount of paper. What it doesn't mean is that the system is about to fail tomorrow. Auctions can and do clear at higher yields. Clearing doesn't equal healthy. It just means price adjusted enough to find buyers. The second data point is foreign participation. Indirect bidders, a proxy for foreign central banks and overseas institutions, have averaged about 62% of recent coupon auctions. That sounds decent until you zoom out. 5 years ago, that number was closer to 70%. 10 years ago, it was often north of 75%. Meanwhile, direct bidders, which include domestic institutions, have been relatively stable. The gap has been filled by primary dealers, who are legally obligated to bid and make markets. What it means is that the marginal buyer is increasingly domestic and balance sheet constrained. What it doesn't mean is that foreigners are dumping treasuries en masse. Holdings have plateaued, not collapsed. The third data point is who is actually absorbing duration risk. Banks, especially U.S. commercial banks, are not growing their treasury holdings the way they did from 2020 through 2022. In fact, adjusted for inflation, bank holdings are flat to down. The Federal Reserve is running quantitative tightening at roughly $60 billion per month in treasuries. That leaves hedge funds, money market funds, and dealers as key absorbers, often via the repo market and basis trades. What it means is the system is leaning more on leveraged, price-sensitive buyers. What it doesn't mean is that every auction is being saved by some shadowy buyer of last resort. It's just a different buyer mix, and that mix behaves differently under stress. Now let's lay out the bullish case, because there is one, and pretending otherwise doesn't help anyone. First, higher yields do attract capital. At 4.5 to 5% on the 10-year, treasuries are competitive with many developed market bonds on a currency-hedged basis. Second, U.S. debt still benefits from regulatory and collateral demand. Banks, insurers, and pension funds need high-quality liquid assets regardless of sentiment. Third, fiscal dominance can paradoxically support nominal growth, at least in the short to medium term, which helps service the debt. And fourth, compared to alternatives, the U.S. still looks like the cleanest dirty shirt. In this scenario, auctions continue to clear, yields stay elevated but contained, and the system grinds forward. I put the probability of this relatively constructive outcome at about 25%. The bear case deserves equal time. First, the buyer base is becoming more fragile. If hedge, funds, or leveraged players are forced to de-risk, there isn't an obvious deep-pocketed replacement waiting in the wings. Second, interest expense is compounding fast. Net interest outlays are already approaching $1 trillion annually, and that feeds back into more issuance. Third, foreign demand may not collapse, but even small marginal reductions matter at these volumes. And fourth, political constraints make fiscal adjustment unlikely in the near term. In this scenario, yields spike, volatility rises, and something breaks. Maybe not the treasury market itself, but a related corner like regional banks or funding markets. I assign this a roughly 30% probability. The middle case is where I live, and it's the least exciting, which is usually a good sign. In this scenario, yields remain structurally higher than the last decade, but don't spiral out of control. The buyer mix continues to shift toward domestic and price-sensitive players. Volatility increases episodically around auctions and macro data, but policy tools are used to smooth the edges if needed. Inflation cools slowly, not dramatically, keeping real yields positive. Nothing breaks, but nothing gets fixed either. This is a grind, not a crisis. I see this as the most likely path, with about a 45% probability. To understand why this feels uncomfortable, it helps to look at history. A useful comparison is the late 1960s into the early 1970s. Back then, the US ran persistent deficits, foreign confidence wobbled, and the buyer base shifted. Similarities include rising issuance, geopolitical strain, and a sense that the old regime was creaking. But the differences matter more. Debt to GDP was far lower then, but entitlement spending was smaller too. The financial system was less leveraged, and capital controls existed. Today's system is faster, more interconnected, and more sensitive to rate changes. So while the rhyme is there, the verse is different. Cross-market signals help us check our bias. Gold has been holding above $2,300, which tells me there's ongoing demand for monetary hedges, but it's not accelerating in a way that screams panic. Silver, trading around $30 to $32 recently, is more volatile, reflecting its industrial exposure. The dollar index remains range-bound, roughly between 102 and 105, suggesting no immediate loss of confidence. And the 10-year yield, while elevated, hasn't broken decisively higher. Put together, these markets are saying stress, not crisis. Positioning data supports that read. COT reports show large speculators moderately long gold, but not at extremes. Silver positioning has rebuilt, but isn't euphoric. Banks are not massively short metals, and institutional allocations to commodities are still low relative to history. In rates, leveraged funds hold significant short Treasury futures positions, which can exacerbate moves, but also fuel short covering rallies. This is a market leaning, not tipping. So here's my personal action plan, and this is not advice, just my framework. If yields spike above 5% on the 10-year while inflation expectations stay anchored, I add incrementally to precious metals, particularly silver, because the asymmetry improves. If yields fall sharply due to recession fears, I trim risk assets but hold core metal positions. Right now, my allocation is roughly 12% precious metals, 8% gold, 4% silver, 58% diversified equities, 20% cash and short-term bills, and 10% alternatives. My stop loss on silver is a weekly close below $26. My first take profit zone is $38 to $40, where I'd reduce exposure rather than chase. There are a few things I'm explicitly not doing. I'm not panic buying because of scary thumbnails. I'm not assuming every debt auction is a sign of imminent collapse. And I'm not letting social media outrage dictate position size. Markets don't pay you for being early to a narrative. They pay you for managing risk. This week, I'm watching three things closely. First, the next 10-year and 30-year auctions. A weak auction with a tail over 3 basis points and heavy dealer takedown would be a bearish signal for bonds and potentially bullish for metals. Second, CPI expectations embedded in tips. A move higher without growth acceleration would matter. Third, the dollar's reaction to data. If bad news strengthens the dollar, that's a sign stress is still being absorbed. If bad news weakens it, the regime may be shifting. Let me wrap this up. 1, U.S. debt auctions clearing doesn't mean everything is fine. 2, the buyer mix matters more than the headline demand numbers. 3, there are plausible bull and bear outcomes, and neither is guaranteed. 4, the most likely path is a prolonged adjustment, not a sudden collapse. If this kind of calm, data-driven breakdown is useful to you, consider subscribing. It helps the channel and it keeps this conversation grounded. Thanks for watching Financial Briefing. Stay sharp.